Hello, traders. Gary Wagner here. It is Thursday, the 5th day of January 2012. It's approximately 11 a.m. in New York City, and we are coming to you from the Mediterranean Sea. We will be for today and tomorrow. I will return on Monday to Hawaii, and we will reschedule our regular broadcasts. We do have the precious metals complex under a little bit of pressure. Currently, we are trading down off about $3 to $4, 16.1120. That is basis, the cash market. Silver also trading a little bit lower. Gold did test and broke below it at a point last night of about 1597. It did find support and did move back up. You do have the Lunar New Year coming up in Asia, and it's expected to put a little bit of additional demand on gold. Interesting article that I read today in which Dennis Gartman has said that he effectively believes that the correction in gold is over and that we are back in a bull run. So he is also agreeing what we have been saying for about the last week. As you can see, we are looking at our daily chart. Our daily chart does have our Elliott wave count as well as some Fibonacci retracement. And what I found interesting as I was looking at the charts today is that when you consider where the market started trading at in February, and that's that low that we saw roughly at the beginning of last year. It's going to get hard to say that, but it is last year. And then when we look at the record high, call that around 1920, you can see that this retracement that we saw, this correction, that I do believe is over at this point. I think that we've had concrete evidence to that fact. You can see that it retraced roughly 61% on a Fibonacci retracement level. And that seems to be a pretty solid indication or a logical place for it to go. You can also see this double bottom, meaning a flat bottom on our Elliott wave. Now, you did get lows that went a little bit below this low that we saw in A, but no matter. In essence, it absolutely does look like we have witnessed the bottom. Now, we'll still have to see. And if that is correct, we are looking at this being on our major count 2 here. We've got 3 here. We came down to 4. And then on our major count, we're officially then in our last impulse wave, wave 5. If all holds true to Elliott wave, we would then see this market not only take off, but take off and be able to beat our old record tops around 1900. That is the reason, of course, that we have been talking about for quite some time, the fact that I'm still looking at 2000 as a potential target or upside move in gold. Now, if in fact it does move there, if in fact it even moves to challenge these record contract highs that we saw last year, we are looking at, traders, a $300 move in gold. That's quite a move. And so I don't think that's going to happen overnight, and I don't think that that's going to happen overall. But I do think that we have that potential in this marketplace right now. Now, when we take a look at how this particular daily chart bears out when we convert it to the Heikin Ashi. And remember, the Heikin Ashi is a Japanese average chart. It is also a Japanese average chart that is based upon averages. And traders, I do have to apologize. The data feed had gone down as we did this report. Currently, it's trading 1604 and not, as I reported earlier, at 1611. 1604, 1605. Nonetheless, what is true, what still remains, is that it did dip below 1600, 1597, as I said, was approximately the low and has come back and, at least on a tentative basis, found support above that point. Now, we have converted this into our Heikin Ashi chart, our daily average chart. Let me go ahead and blow that up. And as you can see, that although the market is down off about $7 or $8 on the day, we still, on the Heikin Ashi, have a green candle and, most importantly, decent size, not really very, very strong because it is a down day, but it has that lack of the lower wick for the second day in a row. Realize, traders, we had 4 up days. This is our first down day, really, since the first of the year. Now, traders, we are looking at our daily chart in silver, and I have to tell you, in no way has silver been faring as well. In fact, if we look at, first of all, our daily candlestick pattern, the pattern itself is almost a dark cloud cover. And when I say almost, it's only because you had such a tremendous range on this day. On any other day where it would only move up $1, you would actually see this candle here close at or below the midpoint. Midpoint being the point in which then it becomes a dark cloud cover. If it engulfs it, of course, if it closes below it, it's an engulfing bearish. We've had a second day right now of the market selling lower. And although the market has genuinely popped up, it had that tremendous move. The fact that I've gotten these 2 black candles absolutely gives me some concern. For that reason, we're in at around 28.10. You probably are going to want to protect some profits. You can possibly, for shorter term traders, put some sort of stop somewhere around 28.50 and look to re-enter on a dip. But as I say, the fact that we've got this incomplete dark cloud cover, we don't have a long black candle following it, but we do have a candle with a lower high and a lower low. Significant in that it tells me there is the potential for this market to, in fact, trade a little bit lower. Now, when we convert it to our Heikin Ashi or Japanese average to give us a little bit more indication, as you'll see, it's still not putting us into sell mode, but what it is telling us is that the body size has gotten much smaller, as you can see, and we have had the reemergence, although of this lower wick right here. You can see it right there. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you tomorrow for the weekly wrap-up and weekend review. Bye-bye.